Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
Okay, let's rock.
All right, let's jump right in.
Leading economic indicators turned negative in the last, like month and a half, 2 months?
We've been pulling this, I think, 2 or 3 months. And it's just this, if you can see where this area here, sort of the red line is this is all done by the BE. So this is all data straight from government sources, and they're interestingly saying here that this is a recession signal that flared a couple months ago.
Yeah. So I think Paul, you put the yield curve in here next.
Yeah.
Okay. There's a couple pieces. Okay. So why is this a big deal? Of course, it's a leading economic indicator. There are many data points that go into this indicator. This is not, oh, yay. Okay. This is perfect.
This is the components of the leading economic indicator.
Yeah.
There's 10 different things where it looks at the financial components from the market to interest rates, and then non-financial components, which are more things along new factory orders, business conditions, and expectations. Average weekly hours.
Stock market, which, by the way, is, in our opinion, the stock market and the yield curve are the two best leading economic indicators that we have. Best, and they're the ones that signaled inflation before we saw it. They're the ones that signaled recession before you saw that leading economic indicator go down. Because in 2022. You know that we have been very cautious with the market because we were seeing a typical churn that takes place with each turn in the economy. So it will churn at the top, it will churn at the bottom. And that's what we saw through 2022, which is why you know that we've been conservative and will continue to be for a number of reasons. Now, the market has rallied, I think, since October, Paul, except going into the Santa Claus rally, which we typically see, and we didn't this year. And that's not atypical. That is very typical that takes place when you have such a steep decline like we did in 22, to have a retracement is normal. Right. So the question we have is, when will the Fed pivot? Because when the Fed pivots, and that's why you see the market rallying, because Wall Street is expecting the Fed to stop raising interest rates. And
even though they've been saying they're going to slow the rate of change, but they are still going to continue raising them.
Yeah, so that's really taking away the punch bowl. So Wall Street's been expecting them to change course, and we just don't see it yet. Can we argue that they should reverse course or at least stop? Yes, we could argue that. And there's a number of reasons for that, because again, we think they're fighting inflation, but the inflation they're fighting won't change with an interest rate change going higher.
Right.
Because the inflation is in the necessities. It's food. I feel like we're a broken record.
I know, we've been saying
I think we're a broken record.
Over and over and over
It's in food, it's in energy, it's in healthcare. Like, You know, the healthcare premiums are up 20% year over year. The Fed can raise rates all they want. That isn't going to change. That is literally a policy change. It's a sea change. It's just,
right. You were just telling me the other day how much more we both are spending on food. And those are things that, like, interest rates don't impact what you need. You still need to buy food to live, right? So if you raise interest rates, you're not going to decrease your spending on food. When the price keeps going up, you're kind of left with no choice but to keep spending and keep spending more.
And you know, there's policy issues, and it's around the globe. It's not just local. So, you know, what is it? 4,000 or 5,000 farmers in Holland are being shut down. Okay, like that is going to create a problem. Now that is a fact.
Puts a lot more pressure.
That is a fact.
Pressure on prices, pressure on supply.
So to our point is, the Fed could continue to do what they're doing. I'm not so sure how much they're really going to be able to affect prices. This is the problem. What they are doing is effectively creating a slowdown in the economy, as you can see in this little line here. Okay, so what we hate to see is stagflation, and I think they've been speaking to this. So in their latest statement, correct me if I'm wrong, Paul, but I think it was the latest statement where they said that they keep pointing to what happened in the 1980s when they stopped raising rates and we went into a double dip recession. You remember that? Yeah. And they stopped raising rates and inflation started licking up again. So anyway, we'll see. So that's that. So looking at economic indicators, these tell us in advance how things are going.
Right. The things that.
Yeah, go back.
Yeah, these are right. Again, it just shows that everything, all these lines that are sort of moving to the left are things that are bringing this indicator down. So essentially they're negatives, right? And things on the right would be positives. There's a lot more negatives than positives, which is why this chart is going down, right? When you look at what some of these components are, you're seeing that average consumer expectations for business conditions have taken a pretty significant hit, which makes sense. I think we all feel that when we're out in the world. New orders have come down, building permits have slowed. That's a part of rising interest rates, right? So it's
funny though. People are still spending money, and that's really it's kind of interesting. Okay, and
these were some interesting charts that just show loan demand from banks, and these are good indicators for basically pre-recession or just good indicators in general.
Yeah, good leading indicators.
You know, is money easy? Are banks lending? Are people going and seeking loans, or are conditions tightening and are they not? The chart on the right shows charge-offs, which are essentially like default, right?
Yeah.
And it's obviously at the beginning down there, but when these things start to pick up, typically that's not a good sign, or a sign that a credit cycle is changing.
Yeah. So I mean, too early still here, but you know, that definitely worth noting. And you can see it's, you know, here was 2007, 2008 slow turn. All right, what do we have next?
So this was a chart from our September update where we were saying, look, this is the 10-year, 1-year spread. It is inverted, and
so let's back up for a second.
What is an inversion?
So here's the inversion that Paul is talking about here. So you can see, so basically you're getting paid more to own a 3-month treasury, which was at 4%, versus a 10-year, which was at 3.5%. Okay, so you're getting paid more for a 3-month versus a 10-year treasury. These typically are a leading indicator to showing us that we are going into a recession. Okay, and that's, so Wall Street was expecting that at the end of the year last year. They're like, oh, the yield curve is inverting, the market's rallying because the market's thinking the Fed's going to lower rates. I just don't think it's going to be that simple this time.
I put an updated chart of this because this was several months old, where this is looking at the 10-year 3-month and the 10-year 2-year. Same idea, where each inversion, where it goes below this line, right, is followed usually within 6 to 12 months by a recession, right? And that's what these dark shaded lines here show, that inversion, recession, inversion, recession, inversion here, 6 months later, recession, inversion, recession, recession, inversion, mini COVID recession, and then inversion right here where we are today. So this has gotten a lot worse than September when we last were showing those charts.
I'll go back to that. So even to what we saw in 2005 and in 2000, you could see, or 2007, really this was like around 2007 and this was in 1999. You could see, or this was actually in 2000, this was 99. And you could see the inversion ultimately led to, predicted a recession. And so this isn't like, to us, this is a major data point, as is the markets, as these are charts. So when could this happen? That's the question. When will we go? But if it follows to script, and as I said to Paul, and I think I said here the last time, I've never in my 36 years of being in this industry ever saw an inversion that didn't show that we were heading into a recession. So, okay. And, like Wall Street loves recessions. Yeah. Once they get past the initial part of the recession, this is horrible to say because I don't think it's very nice, but after I'd say once they know we're heading for a recession, then they know that the Fed is going to flood the markets with liquidity. Now that's the way it's been for 30 some odd years. Now that may be very different this time. And I actually think it's going to be different this time.
There's a lot of people who think that the last 40 years or so are going to echo forward and be relatively the same as, the future is going to be relatively the same as the past. But I think we would both argue that there's many, many data points out there that might actually say, and famous last words, but this time is different.
Yeah, I've never said that my whole entire career, but I actually think it is. And something you have to know is most people in the investment industry haven't, 36 years, I think is a long time. I was in since the mid to late 80s. But it would be great to know someone who's been in for 46 or 50 years who has seen what happened in the 70s and the 80s. And I think this is kind of similar to what we saw then. So what do we have next? Paul and I are calling this recession very likely. How deep is it? Yeah. No, I'm so glad you asked the question right in the middle. So let us answer this. The question was recession very likely. Okay, yes. From a very smart participant here. How deep will it be by your thinking? Well, based on what we see here in terms of I'm really messing this up. I'm sorry. Based on what I'm seeing on this inversion, I would say that it could be pretty significant. And there's a couple things that Paul and I have been speaking to is the amount of civil unrest that we have right now, the amount of anger, the amount of aggression I think we're experiencing.
Yeah, there's a lot of bigger macro trends that weren't really present in previous recessions that are present today that stands to either amplify things or can make them go to extremes.
So let us answer this question. I think nothing in the credit markets is really showing big flags yet. So remember, that's a really big part of our work, is a very important part of our risk measures. If we started to see some things shift there in a major way, then we would have more reason to pause. We haven't seen that yet. So how deep can it go? What I'd be more concerned with, and I think what I would feel more comfortable answering, because I don't know how deep it can go, to be honest with you. How I will answer this is we have more debt at the government level. That's a little scary compared to other recessions. That's a big deal. We have a dollar, which Paul and I will speak to, that's, I think, very iffy. And I think the bigger issue is inflation. We don't think in this country we can hit 10, 20, 30% recession inflation, but we actually are pretty much already there for the necessities. So I think the bigger issue is we call it a reverse stagflation environment, where the price of necessities are higher and your economy is slower. So when I see technology companies that have been on the upswings for 30 years laying off, like Microsoft announced 10,000, I think it's a big deal. An anomaly both Paul and I have noticed is still there's those, we see that there's all these cranes still in the skylines around the country, they're still building. I don't know how, but so to answer that question, we don't know. It's really going to be contingent upon what the debt looks like, what credit looks like going forward. And I think the bigger issue is how far inflation can go and how far that's going to push down the middle class. It's just going to, the separation is just getting larger. And I think that's the bigger issue that we have now. Yeah, we're good. I hope we didn't beat a dead horse there. Do you think we, want to speculate anything? Okay, we got something here. Oh, I'm sorry. I don't mean to be, I know. Yeah, this person is recession to civil unrest, building to service debt. Wait, yeah, no, I mean, look at, you all have worked with us for so long. You know that we don't pull any punches and we're never going to. And
I would add too, policy is going to play a big piece, potentially a big piece in how deep it gets. And unfortunately, we don't know what politicians are going to do. And arguably, our politicians are in a space where there's never been more disagreement or discontent with each other. It's much more harder to find common solutions. So that has the potential to exacerbate things.
Really, we need to be more tolerant of each other, honestly. Yes. That's really do. We all have different opinions and feelings, and really tolerance, I think, is really important right now. Not to preach, but it's really something. Okay, let's look down. Here we go. Okay. Consumer health.
Just wanted to touch on a few metrics involving the consumer, because this is all contradictory, because I see people spending left and right. There's these, multi-$100,000 houses being bought still. But when you look at something like the national average for savings rate, I mean, we're at decade lows. Under well, I think it's 3 or so. It's pretty around 3 or less %.
That's pretty bad.
So not good.
Not good. Yeah, it's in the wrong direction. And I think something, maybe at the end we can show a chart credit debt, because this is one of the things Paul and I have talked about. Where are people getting their money? Debt has to be off the charts. So credit card debt is. We'll show you that chart at the end here. Oh, consumer health. Yeah.
Right. This shows what percent for the median household, how much is their mortgage in terms of their budget, and it's hit a 20 plus year high. Higher than it was. Almost 50%.
Yeah. Higher than it was in the, in the real estate bubble and
41-ish% in 2006.
Yeah. Yeah, and 49% now. 49. And so here's something that you have to keep in mind here. When you see this increase, then that means the price of rent will increase as well. And we're seeing that across the entire country, that rental, being a landlord right at this point in time, they're able to pretty much get the prices they want. It's insane right now. And so this in that direction, housing affordability is still
one more thing that we've talked constantly years about an eroding middle class. And this is one of those metrics that really speak to that.
So this, look at this. So 50% of the household budget. So keep in mind now, with food prices going higher, fuel going higher, and healthcare going higher, necessities. This is a challenge. Okay, so next, consumer health.
Yeah. This is an article I saw published last week, and this is something I wasn't aware of, but I think this speaks to sort of where we are as a country and policy, and that we can do better. We need to. But it shows China's GDP has just grown like crazy, which makes sense because how many billions of people live there. But life expectancy, this one. Shocking. Crazy, that China now has a higher life expectancy on average than the United States.
And look at the drop. Look at how steep that drop is. I mean, the numbers are only X%, but that's still a significant drop. Okay, next. The dollar. So let's talk about the dollar. So if you remember, and again, I don't want to be a broken record, but Paul and I have talked since the inception of this company, that the dollar we think is an absolute risk to be the reserve currency. This is a big deal. Now there's a number of reasons we say this, but what we want you to look at is with each crisis that we've experienced.
First, go ahead. If you can't see the numbers, this chart goes back to 1968.
1968.
This is a multi-decade chart here of the U.S. dollar. And I guess it's a proxy for what is the demand of the dollar. I mean, based on its pricing, right? So the high peaks say that there's high demand for the dollar. Everybody wants it. lower peaks would say there's less demand, less people.
And something you have to remember too, the dollar is the reserve currency. So it after the 70s, it was the medium of exchange around the globe. Not all, but the majority of trade had to, if you were in, let's say Europe, you had to convert into dollar to buy your fuel from Saudi Arabia or your oil. Okay, this is how it's called the petrodollar. So you can see with each crisis, so here's the crisis of 2000, 2001, okay? The dollar rallies, but not as high as previously. Then we come down, and we had the financial crisis, rallies, comes down, rallies, comes down. Then we had, like, let's look at what happened during Corona, rallies, comes down. So what Paul and I wanted to see to know the dollar was going to break out is it had to clear this, what we call resistance, okay? Now, this is just us looking at it technically. Understand, we look at it technically only to support or disprove our thesis. That's what it's to support or disprove our thesis, which is that the dollar eventually will not hold its status as reserve currency. This is a big deal because if it doesn't hold its status, that means that almost immediately all imported items will become more expensive to the consumer, okay? Because it's all about supply and demand. Do you want to add anything to that? We're going to show some.
Yeah, there's a couple more charts of the dollar, so let's just jump in.
Yeah, let's jump. So
this headline was from 2 days ago. What's today? 19. So 2 days ago, big meeting going on. But the fact that I was reading this article and the leaders of Saudi Arabia were openly saying, look, they're looking to and actively moving away and embracing settling oil trades in non-US dollars. So, this is a big, if anyone was saying this 10 years ago,
might have had a bit of war.
Yeah, right.
To be honest with you. So, this is not that, we want fairness everywhere. But you have to understand that this has major repercussions for this country. And this isn't a small statement. So we want to make sure. Now, it all started, like, the nibbling at it started very slowly. Like the emerging markets created their own World Bank, 5 years ago?
Yeah. Okay.
So that's China, India. Oh, okay. Oh, you got to the China, India, Brazil, Russia. They started their own World Bank. Okay. And there's been this talk slowly to move away from reserve. Will it become a basket of currencies? We don't know.
Right. This chart sort of suggests that might be a legitimate outcome where, throughout the past decades, the dollar has really represented the largest portion of any country's reserves. They keep it in dollars because they have to trade in a global economy. And to Alexander's point, you need to buy dollars and sell your own currency to buy dollars in order to really do any global trade. That has been changing over the past decade, pretty much. Yep. And this chart shows that there's been a pretty significant drop in other countries' holdings of U.S. treasuries, or U.S. dollars, right, and moving to a wider basket. Yeah. So this is what now, Paul? What am I doing? Did I do something? No, that was the
last
thing.
That I had. Oh, okay. Can you just go to your email and pull up that one chart that I have, and I'm going to talk to you while he does this. It's the chart on debt. I want them to see where debt is right now. Okay. So I'll talk to you while he goes. So let's go in summary how we're positioning here. Look, I've been through a lot of cycles in the market, and what I know is our markets don't turn around on a dime. So what you saw at the end of the year at the little rally, not the Santa Claus, because usually we get what they call Santa Claus rally. We didn't get that. But usually when you have a bear market, doesn't turn on a dime, you see like a little like churning. It's just like a churning point that typically happens at the end of a bear market and a bull market, both directions. So with that, in the backdrop of what we believe is happening in terms of inflation and in terms of the market, the way we're positioning is we're maintaining a very conservative posture. And we've said this before, it's not sexy. It's not like, you know, this is so great, this is what we're doing, but we know it's the right move right now. And from our perspective, the most important thing is conservation and also giving you a form of yield. So we're actually able to buy bonds. What did we buy? 4.5% yesterday for like 6 months or something like that. And again, it's not like we want to be there for a very long period of time, but what we want is we want to give you some yield, something in the portfolio, while still maintaining a conservative posture and not being in the markets too much. That chart right there.
Load this chart up, and then I will get it shared so we can all see it.
Look at that. That's crazy.
Oh,
yeah.
Okay.
I just have to share this. So, sorry about that, everyone. So anyway, so that's how we're positioning right now. And we have been nibbling, so you know, in the emerging economies. So like we are constructive on India right now, and we even are constructed on some things in South America. And so for the first time, I would say in what, 15 years? So what 2017, no, when was the credit for 2007? So about 15 years, for the first time since, those areas on a relative basis to the United States actually looks intriguing. What Paul pulled up here is credit card debt versus the savings rate.
This is actually that chart we showed before on the savings rate, but then you overlay total credit card debt on top of that. That's that red line, and you can see it's just
35%. Yeah, parabolic.
Massive.
Oh, I hate that. This is really disturbing. Yeah. So anyway, you know, we think that a lot of people are living off of their credit cards. That's not okay. So you have some questions. Did anybody write anything in, Paul, before this? Oh, if anybody has any questions, please raise your hands or write some questions in the box, right? Can you do that with, let's see, in the chat box? Or just raise your hand and let us know. Let's take a peek if anybody has any questions. And if not, that's okay. Don't worry. That means that we may have answered.
Oh, I raised my own hand.
Can you go to the attendees? All right, I don't see anybody raising their hand, but you know always that you can call us and you can ask questions, of course. And do know that we've said this, I don't know how many times, but we're just asking for patience right now. We're right here with you in this process, and you know, we're of one mind, but not one mind enough where we don't challenge each other. So you know, again, if you have any questions, any comments, anything you want to convey to us, you know where to find us, okay?
Perfect. All right, well, thank you everybody for joining. We'll have this posted in a week or so on the website. And again, reach out if oh, maybe we got something.
We have a question.
All right,
I like this. Okay, we have one. Let's see. Oh, why India?
Okay, so a couple interesting points on India. One is the way they're approaching interest rates is very different than how we own.
Yeah.
The other thing is when you look at India's demographics, especially for this decade, and going out forward, they are in full-on growth mode.
Yeah, they have youth. They have youth. We don't have youth. Yeah. They're just coming up, and we're maturing, and they're coming in the opposite direction. So it's kind of like this.
Right, and they aren't the United States or Europe. They're not they're not laden with debt, and they're still able to get energy relatively cheaper than other parts of the world.
Yeah. So that to us looks good, but there's another question. By conservative, totally on equities, not totally. We still have to have representation there because we could be wrong. So far we haven't been, but we could be. And so we really don't want to be foolish and be fully exited.
Right. Our equity exposure is there, but it's just, especially historically, much smaller than it seems.
Oh, this is interesting. So the question is, to save crypto space, did industry leaders save SBF with restoration of funds to consumers?
Yeah, I think a lot is still to be determined there. It does seem, though, that there are a lot of really what's the word?
Backroom,
Backroom deals, revolving doors, secret handshakes with these guys and regulators. So that's sort of.
And so keep in mind, like doesn't necessarily really speak to, in my opinion, crypto per se, really as it more speaks to bad actors, as they call it, and politics and politicians being in bed with these bad actors. Okay, honestly, that to me that's the bigger story.
And that's what, right. And it's almost like it's being pointed to, like, oh, this whole crypto technology and this whole idea is what's to blame here, but it's not. It's opaque third parties who you don't know what they're doing behind the scenes. Just like in any, I mean, fraud is fraud. You can apply, right? It's the exact same thing.
Yeah, and so like. We have respect for Sam Blankman. Is that how you have Blankman? SBF. Okay, we didn't feel comfortable with his level of transparency from the beginning.
Yeah.
So he was a bad actor from the beginning.
From the beginning too, he was never
in the industry
for the technology, right? He always mentioned he was in it for the money.
Yeah. So all right, what do we have? Do we have anything else, Paul, at the very bottom? One more. Okay, so ETF performance. So the market was down what, 20% last year overall? Yeah. So if you had an index fund, you would be down equivalent to the market. And the questions somebody's asking relative to performance. If you're with us, please, make a phone call with us. We'll go over your portfolio with us. You'll see we didn't perform like the market. We did much better than the market last year. So ETFs have their place, but they have to be placed properly. Paul and I had market ETFs last year. The year before, we opted to get out of them. We knew the market was going to go down. We felt it. So we did what we had to do, and we got out of those.
Yeah, and ETFs can be great to overweight specific sectors or for certain thematic plays on certain trends. Exactly, right. Gives us broad exposure to the entire Indian market instead of trying to pick one or two winners. So they have their place in the sort of larger portfolio picture.
Do you have a sense of what the government will do about the debt ceiling?
So it seems like every couple of years, right, we are having the same conversation. What are they going to do about the debt ceiling? We've never not increased it.
We never not increased it. But you wonder if just one day they're going to decide not to.
Right. They've said that if they don't decrease it, there's all sorts of increases. Decrease it. If they don't, or if they vote to block increasing it, apparently there's all sorts of legal challenges to allow the Treasury to still pay its debt. So we just don't know what's going to happen there. To me, it seems like one of these more like circus act things. It just gets people all wild up about this and that. But at the end of the day, if the U.S. doesn't pay its debts because of a failure to raise the debt ceiling, it can create a much potentially larger problem. Because the United States, the risk-free rate, well, how can it be risk-free now if it actually defaulted, right? So it introduces all sorts of much bigger picture, bigger problems.
If they don't raise the debt ceiling, I would say that they're intentionally creating problems. And I'm just at the point right now where I don't want to be pessimistic, but we both question what they're doing. And it's insane. Okay. Because I'm late.
So you want to speak to this first?
Investor sentiment. Yeah, it's so negative right now.
Consensus around negative sentiment, right?
Yeah, but it was positive. Like, this is so crazy because investor sentiment, and this is someone who's been in the industry, so it flip-flops so easy. It goes from positive to negative, like that. And I want to say towards the beginning of this year, like actually in the last few weeks, because we had a rally, sentiment started to go in the positive direction. There started to be more bulls that didn't want to miss out until the last week.
I just saw a headline in The Atlantic that was saying how there's not going to be any recession. Everything's actually really good. And I was like, wait a second.
that person must not live in the real world. I don't know. I want to like drink whatever they're drinking, the Kool-Aid. Yeah.
Not to. Oh, go ahead.
No, go ahead. No,
I was just gonna say not to be too negative too, right? Everything moves in cycles, and there's, you know, we've been in this sort of bullish, positive momentum cycle for the past decade. You know, it can take a couple years maybe to sort of work out some of the excess there. But the one thing I have to count on for my children, right, is human innovation, and that, you know, we'll figure things out over time.
Yeah, that's kind of the bummer. It is true. There was and still is a lot of innovation that was taking place pre-corona. There was a lot of stuff going on, and I think that was really good. But there is something to point out. Like every 7 years, there's these typically, and I know this person's going to know this. Typically, there's a sentiment change, like a true, like at the core change in a recession. So like 1987 stock market collapse. Remember 88, 89, 90, 91, 92, 93, 94, 94. There was a recession, and both bonds and stocks, like last year, actually were negative. Like 5, 96, 97, 98, 99, 2000, 2001, 7 years later. Okay, we had 9/11, we had a recession then. 2, 3, 4, 5, 6, 7, 8, 2008. Okay, we had the financial crisis. And so you're going to say, well, what about after that? Well,
2015.
Yeah, 2015. Emerging markets.
Sovereign debt crisis.
Yeah, sovereign debt crisis. But typically, like, the truth is that looked like that was really going to ripple into this economy, but the Fed responded so quickly that nothing happened. So anyway, I'm not saying that that's going to happen, but there's these like,
is this year?
Well, is it this year or was it 22?
15 to 2022, right?
Oh yeah, we just made it through there, but you can see the markets did start to change. Anyway, just a little piece of information. Looks like we might have another. Yeah. Well, okay. So reflect on Tesla with Leatherman profile of businesses and Kathy Wood's aggressive purchase of Tesla while stock price is low. Okay. Well, Kathy Wood's, and I just want to, like, her whole funds are oriented towards very high beta, high risk technology, you know, artificial intelligence, robotics, you know, new age. I mean, their host of funds are all in that area. And that's great when it's working. I think it's fantastic. And also highly aggressive and not good when it's not working.
Right. When the broader sentiment is not that everything is good and firing on all cylinders, that those sort of super high beta and really ultra growth oriented things don't do well. Right? So.
You know what the Tesla Leatherman profile? I can't say that we know what that is, to be honest with you. We just know that the stock, you know, from our perspective, we owned it at one point in time. We did well in it, and then we exited.
Right.
So, and it's not on our radar right now as something that we would want to look at because we are concerned about the consumer. All right, let's see. Anybody else?
Pain trade up.
That's a good question.
Cool.
You know, okay, so he asked the question, is the pain trade up? And this is a saying, you can tell this guy was in the industry. This is a saying in our industry, like, is the pain trade up or down? Meaning, are you going to miss out if the market goes higher? Like, is it going to be painful if you watch that happen? Is that going to be a probability? I think the pain trade is either way for me. Always, if I'm missing out on the upside or if I'm participating on the downside, it's always a problem. Possibly, I
mean, looking at markets,
I doubt it.
Right, we could just guess in terms of what's happening, but looking at the data would suggest that consumer health is fragile. Sort of social cohesion is fragile. There's just lots of room for uncertainties, and markets don't like uncertainties.
We have more. This person's asking a lot of questions.
Multiple.
Business and the business. Oh, so yeah, they have multiple businesses. Yeah. Well, you know, what can you say about that?
Yeah, they have a lot of stuff that's, you know, it's to be determined if these things go public. Some of them could have huge potential, but I know that Tesla already trades still at huge multiples, and it's come down significantly, but it's still at huge multiples.
And you know, of course, there's criticism that there's one person who owns too many very large companies, very influential. Well, you know, I don't know what to say to that. That's
yeah, I'd rather not speculate.
Okay. Oh, we have more. We love disruptive stocks. The question is, shouldn't we hold some disruptive stocks to capture the return in the long term? Yes, of course, we love that. But there's a time and a place. And if you own we owned the disruptors. We owned Zoom, for example. We owned Zoom. Now we bought that and it went all the way up. We sold it. We didn't quite catch the top, right? But maybe in the seventh, yeah, pretty good. But we're below where we bought it. And you know Zoom was a disruptor, right? So we love disruptors. We love stocks that disrupt, companies that disrupt, but there's a time and a place. Uber, disruptor. Lyft, disruptor. Airbnb, disruptor. All, not all, but some of them hitting new 52-week lows. I'm not interested in that. There's a time and a place. And yes, if you compare it to what Kathy Woods is doing, she has like a disruptor portfolio, no question about it. But she's also down what last year? Significant, like 30–40%. Not interested in that. Yeah, we'll own individual pieces of it. That's great, but at the right time.
We love disruptive tech.
Yeah, and we own it.
Innovative stuff going
Square.
on. Again, it comes down to time and place. And then also it comes down to your personal situation and what your own risk tolerance is and how comfortable you are with these things. So broadly, we would err more towards proper place and time for these kind of investments. But if someone's, you know, comfortable taking a certain amount of risk and has a long time horizon, then maybe that makes sense for them.
But I'm not interested. Like we own Square, for example. We own PayPal. I mean, these things, if we held them now, we've not only would have erased our total gain. I think at one point we were up like 100% in Square. We would have lost all that we had. And it's some of you might even know we had like Bitcoin. We had the ETF of Bitcoin in the portfolio. If we held it today, we'd be at a big loss. So some of this disruptive technology, it's not something you just buy and hold. Yeah, maybe now that they're lower, we would consider them, but not quite yet. So
yeah, I'd want to wait to see more data come out around just the economy as a whole in general.
So this has been great. There's no more questions coming in the queue, but we really appreciate your questions. This is for us very stimulating and it's fun. Yeah. So again, just you know where to reach us, and you know that we have your back. We're doing the best that we can for you, and we're just asking for some patience while we go through this time period.
All right.
And thank you so much, everyone.
Thanks, everybody. Have a great weekend.